kick off our afternoon programming for the Digital Asset Summit in London 2024. I hope everyone's having a good time. This is the breakout stage X. If you're looking for Y, it's a little bit further down the corridor, but I'm not going to keep you too long. My name is David Canellis. I'm going to be your MC for this afternoon session, and it's chock-a-block, so we're going to kick straight to it. Our first panel this afternoon is collateral mobility in crypto, and the panelists are going to be discussing security and capital efficiency. So give a warm welcome to our moderator, Mike Ippolito, who's going to introduce our guests. Thank you, everybody.
Hey, everyone. Hello. What's up, everyone? How's the energy? How are people feeling? That's not going to cut it. Guys, come on. Energy, food. How are we feeling? Great. All right, everyone. We're going to be talking about collateral mobility today. We've talked a little bit about, for those of you who sat in during the main stage this morning, we talked a little bit about market structure, and this is going to be a much deeper dive into one specific, extremely important part of that. So before we get into this topic, I'd like to just do a super quick round of intros, if we could just go down the line.
Sure. Nice to see you all. I'm Leo Mizuhara, CEO and founder of Hashnote. Hashnote is an on-chain first asset manager. Among our products are a CD20 fund that was actually just press released a few minutes ago, I understand, and USYC, which is our money market token, which we'll be talking about today.
Hi, my name is Luc Strijers. I'm the Chief Commercial Officer for Deribit. We are one of the biggest derivatives platforms out there with a focus on options. 2/3 of our business is options. Open interest is around 35 to 40 billion at current price levels, and we plan to extend that going forward.
Afternoon, everyone. Mike Roberts. I run the revenue department at Copper. Copper's a crypto custodian, but we're very famous for our off-exchange settlement solution, which is now the biggest in the market, partners with good friends at Deribit, etc., and trading with firms like Cumberland.
Nice to meet everyone. Thank you for having me here. My name is Paul Kremski. I'm the head of business development for Cumberland. Cumberland is the crypto arm of DRW. We are now in our 10th year of operating. We're one of the largest OTC desks in the space. We're active in token liquidity provision, and in really all aspects of market structure and trading.
So folks might notice that this panel was selected particularly because we have a bunch of different types of market participants who can give us all the different sides and perspectives of this particular issue. And maybe before we get into this idea of collateral mobility, I want to start with this problem that's unique to crypto market structure, which is the pre-funding problem. So whoever's feeling bravest, can one of you take a swing at describing what that is and why it's an issue?
Yeah, I mean, I should cover this really. So it's a situation where crypto has kind of grown up with assets being on exchange because of the finality of settlement, and then to improve kind of market structure and bring the institutions to the space. We worked with Deribit as the first exchange to move the assets off exchange. So we have a technical integration with Deribit where the assets sit off exchange. They're in an insolvency remote trust structure. So it looks after Deribit's interests, it looks after the client's interest. It's insolvency remote to Copper's balance sheet, which is very, very important in this space. And then it optimizes collateral across the exchanges.
Perhaps from an exchange perspective, it's slightly different. So in the traditional space, there would be GCMs, clearing houses, clearing brokers, guaranteeing a trade to settle, the margins to be paid, etc. From a crypto angle, all of that doesn't exist. So platforms like us are the full vertical. We are the broker, we are the platform, we are the custodian, we are the clearing house, we are the GCM. So it means that whenever a trade has to happen, or should happen, we need to make sure that both sides of the trade can actually handle that position, which means that in order to avoid our risk and the absence of guarantees, all trades have to be pre-funded, so capital has to be allocated at the platforms. In our case, and especially since FTX, a lot of concerns grew with regards to platforms and their health. So before FTX demise, we already started working with Copper. We recently launched 5 blocks of exchange custody. We work with Kobo, and we plan to work with a variety of other custodians, because even though we love working with Copper, we believe that in the end, there should be custodial choice for the large firms, and if some firm wants to work with custodian X, a platform like us should facilitate. So pre-funding will stay unless markets move into a more traditional setup like the regular derivatives. But as long as it's here to stay and platforms like us will stay, these custody solutions should evolve and platforms should facilitate. So, and that's what you see happening nowadays.
If I could address this from the trading side, and I think you hit it on it a little bit, we're trading billions of dollars of crypto assets a day, whether it's Bitcoin, ETH, or stablecoins, et cetera. We're constantly trading very large size. And then when you look at our risk team, and our risk team says, okay, here are the limits that you're allowed to keep on each of these exchanges. Being responsible risk managers, they're setting limits that are really a very small fraction of those billions of dollars of volume that we're moving per day. So we kind of have two solutions. One is we could just be constantly moving assets on and off platform, right? You buy $1 million of BTC, you move it off, and you move stablecoins back on, and you do it again. And that just doesn't scale very well. Or you could go with this option where you keep the assets off platform, you get credit on platform, you're able to trade all day, knowing that you don't have that credit exchange risk where even the best exchanges, we're not going to have, a firm like ours is not going to have put $250 million on the exchange. Like, our risk managers aren't going to sign off on that. So for us to be able to scale our size, these off-platform options are incredibly important.
Yeah, so I think there are sort of two issues that we're starting to tease out here, which is collateral mobility, but then there's also counterparty risk, and those are really tied. And for folks out there who have an understanding of traditional market structure in TradFi, this might sound a little strange. It'd be pretty bizarre to have an exchange be the same entity as the custodian, be the same entity as the folk who does. So how sustainable do we think this market structure is, or are we going to start to unbundle some of these activities and have copper support settlement, separate custodians, et cetera?
I think what you see happening nowadays, and Copper and us working together is the best example. There is unbundling. So it started out with the full vertical. I think from a brokerage perspective and the exchange integration, it will remain like that. So it will. I don't really see the need to add another layer. But from perhaps the clearing side, but especially the custody side, it's already happening. It's not something that could happen. There's many platforms out there, and clients want choice. So there won't be 10, 20, there will be, I guess, 5 going forward. And these 5 will work together and they will form partnerships. Because in the end, a firm like Cumberland won't most likely choose one custodian. They want access to a few routes. So they will work with, let's say, 3 custodians, and the platforms that want to welcome Cumberland as a client need to facilitate these 3 custodians, and otherwise their risk limits will be so small that Cumberland or whoever won't be able to trade properly. So a few years from now, I think there will be developments in the clearing space. So who's going to guarantee those billions of dollars of positions? Will it still be the exchange? Will it be the exchange via some kind of third-party entity, a trust, supported by some sovereign wealth guarantee? Will it be some fund with injections from some sizable banks? Who knows? But on the custody side, it's happening today. It's a trend going forward, bringing a lot of new clients because it unlocks flow that was otherwise inaccessible.
I think it's worth comparing.
You go, please go.
I think it's worth comparing to what we have in TradFi. In TradFi, you have a number of choices, right? You have the separation of the custodianship from the exchange, and you talked about the credit risk that mitigates. But on top of that, and perhaps equally or more important, is the efficiency of collateral in traditional finance, right? We have prime brokers where we typically leave our capital and we get credit from them. They're able to very efficiently deploy our capital to the exchanges and then on top of that offer leverage. And that's something we don't have in crypto right now. And that's one of those things that's going to unlock a huge amount of potential mobility in trading. But either way, whether your funds are at a custodian or a prime broker, somehow you have a bunch of this collateral that's going to be at rest at one of these institutions. And I think that's a really important part of the system to take into account, right? You're going to have some sort of collateral. You want to minimize that if you can, and whether that's by being able to use a solution like Clearloop to be able to say, that's essentially like a prime broker solution. They're able to efficiently move collateral around. And you want that collateral to be earning you some yield, which is part of what we're trying to provide to this ecosystem as well. in TradFi, it's very normal to earn yield on your collateral at rest, whether it's at a prime broker or at a custodian. And in crypto, we've gotten used to paying Circle and Tether all of our yield. So we're working to kind of fix that as well. Like, I think collateral mobility and efficiency all comes from drawing on the same efficiencies that we've seen in traditional finance, while drawing upon the strengths of blockchain, like fast settlement and this ability to move, like the mobility portion coming from the crypto side.
Yeah, I mean, so to add to that, when you talk about mobility, the first time we margin called an exchange, and I was just joking with Luke about this earlier, was on a Saturday. It's quite strange to me. I joined from Bank of America. My risk manager was from Bank of America. I'm sitting on the sofa watching TV with my laptop open with the risk manager, messaging Luke. He settles BTC on a Saturday, covers the margin call and exchange. So collateral mobility is there 24/7, 365. You know, what we're also doing with Clearloop now, to your point, to make it sustainable, is we've added multi-custody to it. So BitGo signed up, Zodia signed up, Kameno signed up, so those integrations are happening. So then we move on to the next thing, which is exactly what Leo said. If you're deploying that capital on exchange, we want to make sure it's yield-bearing, it's earning some interest. So, you know, we feel like we've solved the collateral mobility issue. The next thing is the yield mobility issue, which is all three of us, all three firms, or four firms actually, are working on that together. Lastly, it actually allows us to bring in agency lending into the ecosystem. So whether that's a prime broker that wants to put their book into that kind of platform we've created, or agency lenders like miners or family offices, etc., that are long Bitcoin or they're long stable coins, etc. It gives you that network where you can optimize your trading strategies.
So just to plug our partnership, right? Copper is actually the first custodian who's going to be using our product, the USYC money market token, for this agency lending, for the ability to post it to exchanges, and really start to move this yield-bearing collateral around in a way that we've never seen anywhere else in the blockchain world. Our backers at Cumberland also are able to supply some liquidity to this product, as well as help with these sort of like lending protocols.
Yeah, we're able to basically, USYC, I believe you are down to T+1, which has a pretty significant lead over some of the other products in the space.
We're T0 now, most of the time.
And guys, can we just give an overview of what is USYC for folks in the crowd who might not know?
Yeah, sorry. So USYC is Hashnote's yield-bearing token. So I guess one thing to clarify is that it's not a stable coin. It is a token whose price goes up. It's an ERC20 on Ethereum. It earns its yield from reverse repo and treasury bills. So reverse repo and treasury bills all custodied at Bank of New York Mellon, so as safe as it gets. And our primary goal for this token was to be able to be used as collateral for OTC trading, collateral for exchanges, the ability for custodians like Copper and all their partners, right? We've got Copper, BitGo, Komainu, they're all able to custody this token, and the goal is to be able to use this for trading as collateral for lending, and make it a very useful yield-bearing token in a way that we've never seen in the DeFi ecosystem.
Yeah, maybe Paul, I could call on you a little bit here, because I think the capital efficiency and yield point is so powerful, and it's going to determine so much of the market structure in the coming years. But maybe to just draw a line on the pre-funding problem, why it's an issue from a capital efficiency standpoint. If you have a very active trading strategy, which I'm assuming DRW has, you have to be active on multiple different exchanges. And if you have to pre-fund all of those different accounts at any one given time, necessarily, you just have a lot of money or capital that's just sitting there not earning any sort of yield, right? So I can imagine that USYC is a really interesting product for you. Can you give the audience an overview of what your sort of like treasury management sort of flow looks like today, and how USYC changes that?
Yeah, absolutely. Capital in crypto trading is very, very expensive. So for a firm like ours, which is trading continuously around the clock, supporting liquidity in multiple pairs, trading for our own strategies, we have to be extremely vigilant about capital efficiency. And something that is pretty capital inefficient, and a lot of folks here know me as kind of a stablecoin guy, but holding stablecoins in your wallet is pretty inefficient from a capital efficiency standpoint. So if we're going to hold coins in our wallet, and if they're going to be sitting there, we want to make sure that we're receiving yield on it, and it's actually being productive. we also want to make sure that we're able to move these assets back and forth very, very quickly. If they're stuck in one place for a long period of time, that's extremely inefficient, and it basically counts against us in terms of, okay, if it takes you 6 hours to move it from here to there, that's 6 hours that you have unactive capital, which is killer for us. Everything in this market really depends, when you're doing high-frequency trading, when you're doing large size, handling liquidations, things like that, you just have to be able to turn the money over multiple times per day in order to kind of keep the machine moving.
And can you talk a little bit about where liquidity is concentrated in terms of trading pairs today? My understanding is it's still like 70% Bitcoin and ETH trading pairs for the most part. Is that right?
Yeah, that's absolutely right. I mean, we pay a lot of attention to alts because it can be more exciting, more interesting, but still a lot of the trading is in Bitcoin, isn't on Ethereum. But you missed something that's pretty important, which is when it comes to at least the OTC desks, 40% of our volume is on stablecoin versus fiat, right? And so that's actually one of the main use cases, as it turns out, for the OTC desk, is that on and off ramp. And if you're ever looking for improved pricing on these types of things, tell us you can settle quickly, right? When someone says they want to do a trade with us, but it's going to take 4 hours to settle, they're not going to get a sharper price. And it's because of this issue we're just talking about, how we want to be able to turn over capital multiple times in the same day.
That's super interesting. Do you see, I guess for the rest of the panel as well, do you see liquidity still concentrating around the majors like Bitcoin and ETH? Do you see it dispersing through stablecoins, maybe yield-bearing stablecoins, or almost like treasury-like assets like USYC? Do you see that sort of stealing some of the market share, quote unquote, from Bitcoin or ETH, or how do you see that entire dynamic playing out?
Yeah, so the way, if you guys don't mind, I know I'm talking a lot. The way we see it, and we look at what our role in the market has been, and a big part of it has been facilitating on and off ramp. And then we look at a product like USYC or other tokenized money funds, and there's something that we have to be pretty clear about. And I'm going to say it the way that legal told me to say it. Tokenized money funds are likely to be deemed a security. I'm not going to say they are a security, but they're likely to be deemed a security. And what this means is that most of the exchanges are not just going to likely just say, yep, we're going to list this as a trading pair because these aren't securities exchanges, and they don't want to draw the wrath. And so there will continue to be a role for stablecoins in crypto trading, right? So really, what is the ideal user experience here? For me, the ideal user experience is I'm sitting in my wallet and I'm holding USYC. And then when I want to trade, I want to buy some ETH. I swap that into a stablecoin. I use that stablecoin to go buy some ETH. And then just to really put a bow on it and kind of complete the loop, I then take that ETH and I convert it into staked ETH, or I stake it in some way to get yield, right? So now I've basically done this transaction. I've done it on exchanges, and I've done it in stablecoins and ETH. But I'm spending a very, very short amount of time with non-yield bearing assets, right? For the most of that time, I'm in either USYC or in staked ETH and accruing yield on that. And that is really important. And I think it's really important to focus on USYC and similar tokenized money funds. They're not stable coins. And Leo talked about how it's not a stable coin because the price kind of inches up. But they're not stable coins because they're not likely to be the thing that we use to buy and sell crypto, right? So there's still this role for stable coins. And it's kind of separate from the tokenized money funds. And so what we view our role in this next market cycle, in a similar way in the last market cycle and ongoing, how we are basically the bridge between fiat and stablecoins, which are in a way kind of not interoperable with each other, we view that to be a big part of our function in the next market cycle, where people will want to move very, very quickly between stablecoins and tokenized money funds. And we view that as going to be a pretty big part of our role in the market going forward as an OTC desk.
I think this is interesting because it ties together three things that we've been talking about. So you have this yield-bearing stablecoin. Now we have to allow for very fast mobility, right? Like Paul was saying, if you've got coins in flight for 4 hours, that's hugely inefficient for a trading firm. So USYC, one of the reasons why I think we're getting some uptake on it is because you are able to mint and redeem this instantaneously, right? We've entered into a partnership with PayPal to be able to do that instantaneous redemption and solve that problem for Paul, right? To some extent, I think the fact that you can now move more quickly from stablecoin to yield-bearing coin And to some extent, if you can do that quickly, you don't need to do the fiat leg as much, right? A lot of the fiat leg is because people are moving into fiat to gain interest overnight and then come back into crypto the next day. So you can keep everything within the crypto ecosystem. Now, to your question about does this take market share from Bitcoin or Ethereum? If anything, I think it increases the volume of Bitcoin and Ethereum, right? Like you're now able to do that velocity, do that trading cycle much more frequently during the day, and therefore you should be ending up with much more volume, which is good for all of us.
I think the focus for this discussion at least is on the higher frequency stuff, but I think what we see as an exchange, so we are 80% institutional, so we're unlike some of our peers where the focus is on retail, we have institutional business. And if you look at the large, let's say hedge funds, buy-side firms entering, they don't necessarily need the velocity you're explaining, they simply need efficient collateral, so they need cross-collateral. So our product shelf is options, and if you look at options, it's like, let's say, 25 billion in open interest in BTC options, 12.5 billion in ETH options, and the rest is all minor. So your answer or your question is addressed by BTC and ETH are very much the focus. And they want to trade those products by depositing stuff that they're used to. So if you look at any global market, you deposit treasuries, money market funds, that kind of stuff. That's what they're looking for. Not necessarily in our case to move it all the time and have the most efficient trade on 20 different platforms. A lot of these firms trade only 1, 2, perhaps 3 platforms, and that's it. So they simply want the yield. So they're losing out by using USDC, USDT, they're losing out on 4 or 5%. And I think the big question for us would be, as a platform, can you facilitate efficient cross-collateral, and can you accept other stuff than those 2 stablecoins? And that's where this discussion comes in. Can we accept money market funds, treasuries, in a way that facilitates the entire industry? And I think we can and we should. And I think the key in unlocking more size to come, the people here in the audience, is to allow that stuff to move freely, multi-market, so not only on Deribit, on multiple markets in an efficient way. And I think, let's say 6 months, 12 months from now, that will be sizable. It has to be.
Yeah, and I mean, to put a bow on this, to complete the circle, so we've heard a lot about how trading firms work, how the expectation of exchanges, how quickly things need to move. And that's where copper kind of stands out in that, our signing times from cold storage, so protecting the asset for a trading firm like Cumberland, on average since the inception of copper is 6 minutes. So we will sign 24/7, 365 in 6 minutes, which is extremely important when someone like Cumberland's trying to, move out of a particular coin, go and settle an OTC trade, get that asset back, put it on exchange. So, that's one of the main things we do. It's kind of lost in the weeds, but it's important.
And we're normally hassling you after like 5 minutes.
Correct. So we're now being asked for 4 minutes, etc. So our middle office is delighted with that. But yeah.
Yeah, Luke, I want to go a little bit further down that rabbit hole of cross-margining, because that's a whole other discussion. But just actually one final question on this. I'd be curious where this panel would slot, one instrument that I think about something like Steth and where that belongs. That's sort of an interesting mix in between Ethereum, and it's sort of the synthetic, which is also yield-bearing, and it's pretty crypto-native, right? It's issued by Lido, and I'd be very curious where something like that would slot into everything that we're talking about.
I'm going to go Paul.
Yeah, sure. I mean, I would go so far to say that, USYC or tokenized money funds in general to stablecoins is very similar to staked ETH to ETH. One of the things that we've actually wanted to see, maybe we can talk to you about it, is on the exchanges, like, why am I going to the exchange and trading ETH? I'd rather, because if I'm buying it, I'm probably immediately turning it into staked ETH because I want the yield. So I'd actually love to see exchanges start to actually list this as a trading pair. Because it's probably not likely to be deemed a security in the same way as USYC. But to me, this is actually like a much more interesting pair to trade, because if I can get the yield and I feel safe in it, and I mean I personally do, I'd rather get the yield-bearing instrument, right? I never want to spend any time in missing out on yields, because that's just opportunity cost.
The complexity is in the instruments that settle in ETH.
Yep.
So we're planning to add staked ETH, but if you have a ETH future position that settles in ETH, not in staked ETH, in ETH, you need to have staked ETH. So the question is, as an exchange, how much ETH versus staked ETH require you to have. And those are the details that matter. But overall, you're fully right. Lots of people ask, if you can get essentially almost the same instruments with a few % extra yield, why not add it? So we should.
So we have it listed on a number of exchanges, but it's a risk decision. The exchange needs to look at the liquidity, etc., and then they'll give us a limit for how much. But we are settling staked ETH on a handful of exchanges, but it's capped for the reasons that Luke's just explained.
And I think that's kind of an inevitable endpoint, right? I kind of called on Paul because I knew his answer, but I think it's almost inevitable that the direction we're going is for more efficient collateral across the board, right? I think of one of the huge unlocks from the crypto ecosystem is all of your assets should be earning at all times. And I think that of all of your assets, right? Like you have home equity that's probably doing nothing, right? Shouldn't we be able to do something with that? And that's going to come during the cycle. But I think staked ETH is a great example of something that we should be doing something with all the time. One of the products that Hashnote has is actually like options vaults on various products. And we almost always do our ETH product on staked ETH because why would you collateralize an ETH when you can collateralize in staked ETH? So this sort of composition of multiple yield-bearing products, being able to use that on exchange, being able to use it everywhere in the ecosystem, I think is inevitable. It's just we're not there yet. And also, the whole rebasing thing makes things tricky for some people technologically.
I should have asked actually before, but how many folks in the room are familiar with stETH or staked ETH as an instrument? Okay, cool. Actually, then I feel good. I feel good. I'm not going to try to explain it. It's complicated.
About 33%.
It's risky. Okay, I want to move into some of the discussion around cross-margining. Maybe this is a good time. I would love... Would you mind giving us an explainer of ClearLoop, actually? Because that's a product that exists to solve a lot of the problems, frankly, that we're discussing.
Yeah, I mean, cross-margin is not part of ClearLoop yet. It's something we could consider, but look, we are driven by client demand. So, as we've said a number of times, look, Deribit helped us get that off the ground. We have a number of the biggest exchanges in crypto, OKX, Bybit, etc. They're all on that platform. It's very, very powerful for derivatives. Because to Luke's point, the collateral is there maintaining trade, so it's very powerful for that. We handle spot transactions through it as well, and we're improving that all the time. Again, that comes down to what can the exchanges settle, what have they got in the treasuries, etc. So when we trigger spot settlements, we need to think about that. The most interesting thing about ClearLoop, and talk about this moving past the cycles and the promise of blockchain, is it settles every 4 hours. It flushes risk out of the system every 4 hours. You can't do that in traditional finance. It does it 24/7, 365. We can increase that cadence. So, and this is the push-pull factor with clients. You've got a firm like Cumberland saying do it in 4 minutes. We've got to, all the ecosystem's got to move. Luke's running a massive exchange with a lot going on. We slowly tune those things up. And the more you reduce that risk in the system, it increases collateral mobility, etc. So it's a very powerful product from that perspective. And then what it's then allowing crypto to do is kind of solve the prime brokerage conundrum in the right way. Because prime brokerage in the traditional space is collateralized lending. If you take a margin loan off a prime broker, that is replaced with equities or bonds that are repoed in the market. The cash comes back into the prime broker, and then there's a fee charge for that that repo transaction that replaces the cash. Uncollateralized lending in crypto leads to perverse incentives and bad market structure. So we've put that in place now to allow prime brokers, etc., to do kind of a more traditional structure, and that's where Hashnote is going to become very important. Because collateral in crypto is, very, very precious. But if you're earning 4.5%, 5%, you can start thinking about using that to collateralize loans. So, the whole idea is to put the market structure into a place where different participants can come in the absence of banks, and provide institutions like Cumberland the solutions that they need and want.
Yeah, I would love, maybe, Luke, if I could hold your feet to the fire here as just a very early user of this product. What was it about it that appealed to you from the Deribit side?
I think in the end, we started working with copper already before there was like panic in the market. So it's not a protection mechanism, it's a growth mechanism. So first of all, it's extended sales. So we partner together and we have a bigger reach. So we don't need to sell it individually, we can do it together. But perhaps most importantly, and that's what I personally strongly believe in the end, if you believe that, let's say we're here, and this is where we're heading, and these are all the investment banks these investment banks or hedge funds or massive firms, whatever their activities are, they won't deploy hundreds of millions of dollars to crypto venues. We have started out, in our case, in 2016. By now we are almost regulated, so we're about to announce a VARA license. We have ISO certification, SOC 2, all of that stuff by now. But all of that stuff is like normal for half of the people here in this room. They're accustomed to having all of that. And when we started partnering, all of that didn't exist. No platform had that. So if you want to get trust, if you want to raise the quality of the overall platform, you shouldn't force your clients upon us holding the entire vertical. You should enable custody of choice. That's what they offer. They call it collateral management, so it's more than custody alone. But in essence, a large firm that deploys 100 million, multiple hundreds of millions, should be able to choose how to allocate these assets. And only if you facilitate that will you be able to grow along these lines. And that's what we believed in and still do.
You have to have an institutional mindset, which Deribit have because they serve institutions. That's the conundrum we've needed to solve. And we all talk about crypto kind of grew up retail first, which is great. It brought retail to the market first. But then there's that pivot for institutions. It's a very, very different model you need to offer institutions versus retail. So this was a natural fit working with Deribit because they are institutionally focused. But I think the exchanges that have big retail books and now are connected to Clearloop, they would testify to the fact that there's multiple $1 billion of IM in there now per exchange. Their books are growing, and Cumberland will tell you, a risk manager will look at it and go, listen, I can allocate more to that. We've got a transparency dashboard that a lot of the market look at. Cumberland helped us design it, and it actually shows the assets inside the trust, how they're settling, how they're moving. Now, that was born out of some of the designs that we had to build in the traditional space for client asset protection after 2008. So we're using this DNA all the time, but working with firms like Cumberland and Brevin Howard, etc., to fine-tune it for the the digital asset space. The technology allows you to do a lot, but you need to have an institutional mindset.
I think that point of crypto starting off almost exclusively retail, and now we're sort of retail grassroots-driven movement, and then growing up, deeply resonates with at least me. Just as an open question to the panel, I mean, where would you say we are in terms of the institutionalization of the market or development, right? If I asked you guys, and there's a lot of different ways that you could slice this question, is this primarily a retail market today or an institutional market? How would you guys think about answering that question?
I think we're at a really interesting inflection point. Part of the way I answer that question is I voted with my feet, right? I was in traditional finance. I was actually working at DRW before starting Hashnote. We're backed by them, and they got a lot of support from them coming out. And the reason I did that was because I thought this was the moment when institutions are about to come on board. I could see those conversations happening at all the major financial institutions. And I can see that they knew they had to do something, but didn't know how to get there yet. And when it comes down to it, crypto-native institutions like us are going to be more efficient in this new blockchain era than those traditional institutions. So we're going to be in competition with them for a while as they come into the space. But you should expect all of these folks to be more efficient in this space and overtake much of that market share as time goes on. But you see guys like BlackRock coming into the space now, right? They're coming in. Is that announced yet? I'm not sure. But BlackRock's coming out with a pretty significant product, and it's like an open secret at this point, right? But if a player as big as BlackRock is coming into this space, they're here, and they're ready to compete. But the question is, how crypto native can they really be? Are they going to be able to integrate into all the products that we here in this room have built? Are they going to be as mobile as we are? And I think as that competition goes on, more traditional firms are going to have to start using our products. And I think you see that with Copper, right? Like in Cumberland too, for sure.
Actually, we've got 2 more minutes here, but I want to actually rephrase that question for the 3 of you. And I think this is the question that I actually was trying to ask. Thank you. There are basically these 2 different points of view or frames of reference that I've seen in this industry, which is that one, TradFi is going to come in here and win the entire market, right? Thank you, crypto natives, for your first 14 years, but we'll take it from here, sort of thing, right? We're going to And then there's another point of view, which I think you were just alluding to, which is actually, there's a little bit of Clay Christensen disruption going on here. And they've had a long time. There's been 14 years to move in. Maybe some of the incumbents actually have much more enduring moats than it might appear. And actually, there's going to be an enormous amount of disruption, and there are going to be new institutions that spring up. And so maybe I could rephrase that final question to the three of you. How do you see that playing out?
I think from an exchange perspective, we've seen a lot of competition from the traditional space for multiple years already. So I don't think it's something that can easily be won, especially when looking at options. They expire up to, let's say, a year from now. So it's like sticky. You don't move billions of dollars of open interest just because the fees are slightly lower or because some tiny improvement here or there. So I think the crypto space, but there's like hundreds of firms and platforms out there. I think it will be reduced to much less. So not all of them will be out there a few years from now. There will be consolidation, who knows? Traditional firms might buy into the crypto space. But I don't think that just by being out there for like 100 years, the pie is owned by the traditional firms. It's been proven that it's not. The new space has been built by all of us and will own a subset of that because there will be more competition. But more competition will only thrive volumes and arbitrage flows and all kinds of new stuff that isn't available today. So I think it's a very positive trend which is happening today.
Yeah, I mean, look, from my perspective, we want to have the rails ready for when the institutions do come. So we were here for the back end of the last cycle, and obviously in the US, that's where the big pots of money are. And for us, a firm like Copper, like we're axed, we've got certain areas of speciality and other areas where we can't service parts of the market. So multi-custody is very key for us, right? We add firms like Camino, Zodia, BitGo is probably going to unlock the US market, an area that we can't unlock. So we have to have everything in place so when the institutions come, they can get the service they want with the providers that they need. I don't think that was there previously. So I think there's more opportunity for the institutions to really take hold this time around.
Close us down, Paul.
Go down the line, yeah. Look, I think that the point that crypto has been a very retail product up until now is certainly true. And frankly, the platforms that have served retail really well have made a lot of money. But I won't say what inning we are of the institutions game, but the ball game has started, right? And there's this temptation to just make a product or platforms that are just really serving retail because retail are here now and providing revenue. But you almost have to really think through, like, okay, what's going to happen 2 years from now? What's going to happen 3 years from now? From a regulatory standpoint, from an infrastructure standpoint, from a legal standpoint. You kind of have to do the work now so that when the institutions are here, everything is ready. And so I think a lot of what we've been talking about up here is kind of like the nuts and bolts and the picks and shovels stuff. And it's not, frankly, the most exciting stuff. Like, I'd love to do a meme coin panel as well.
I was wondering when we were going to get to this.
I'll just stick around and do that one, yeah. But you kind of have to do this work so that when the largest clients, the institutions come in, that you're able to service them properly.
Awesome. All right, guys, that's all the time we have. Give our panelists a warm round of applause, guys.